In this short video, we will discuss margin risk. We will first define financial margining and then elaborate on how margin is used within the financial markets. We will then go on to discuss the risks associated with margin and how these risks can affect a portfolio of stocks or futures. Margin is collateral that the holder of a financial instrument has to deposit to cover some or all of the credit risk of their counterparty. Margin is the most often associated with brokerage or an exchange. The collateral that can be used to post margin can be in the form of cash or securities and is deposited in a margin account. In the United States, margin was formerly called a performance bond. Most of the exchanges today use the standard portfolio analysis of risk, otherwise known as SPAN, as a methodology for the calculation of margin on futures and options. SPAN was developed by the Chicago Mercantile Exchange, which is the largest future exchange in the world, in 1988. Initial margin, which is also known as future requirements or original margin, is the first of two margins that all futures traders must be familiar with before actually trading futures. Futures margin is one of the most confusing aspects of futures trading. Initial margin is the first of these margins and is actually nothing more than a deposit you give your broker when you open any futures positions. The initial margin is paid no matter if you are long or short a position. Generally, initial margin is the minimum required value in an account necessary to open a position in a futures contract. For stocks and stockbrokers, according to Regulation T of the Federal Reserve Board, the initial margin for stocks is currently 50%. This level is only a minimum, and some brokerages require you to deposit more than 50%. More and more clearinghouses and futures exchanges around the world are adopting the SPAN risk array for margin. This is a complex computer system that attempts to determine the worst possible single move of a futures position and determine the initial margin requirement based on the calculation instead of applying a standard rate across the board for all market conditions. The objective of SPAN margin is really to lower initial margin requirements to more realistic levels so that futures trading can become more accessible. This system also rewards sophisticated futures traders who apply hedges to their positions in order to lower risks and therefore their initial margin requirements. The initial margin is a kind of guarantee that you have money to pay for your losses should losses occur the very first day the position is placed on your books. For instance, if you bought one contract of oil futures, you would be prompted for a futures requirement of approximately $6,000. That's on a 1,000 barrel contract, which is currently trading around $90 per barrel. You are putting up $6,000 to have control of $90,000 worth of trading instrument. The whole margin system is a mechanism to make sure parties involved have sufficient cash to cover losses in order to make sure that the clearinghouse can guarantee payments to all participants. Generally, maintenance margin is the amount of money an investor must maintain in his or her account to keep an open position on futures contracts. Should the value of the investor's account fall below the maintenance margin, his or her broker will require a margin call, meaning that you will have to post more money to come back to a level that is considered acceptable. A stockbroker's demand on margin indebted investors made if the investor's debt is in the investment increases above the maximum allowable amount. To increase the amount of cash or the other collateral in the equity account, and to bring the investor's margin back down to the maximum allowable level. Margin buying is buying securities with cash borrowed from that broker, using other securities as collateral, or cash as collateral. This has the effect of magnifying profits or losses. The securities serve as collateral on the loan. The net value, the difference between the value of the securities and the loan, is initially equal to the amount of one's own cash used. The difference has to stay above the minimum margin requirement, the purpose of which is to protect the broker against the fall in the value of the securities to the point that the investor no longer can cover the loan. Margin risk is related to the ability of a portfolio manager to hold positions based on potential margin or the lack of collateral. If a portfolio manager receives a margin call, he will be prompted to post collateral to the account within a specific time frame. If the collateral is not posted, the position will be liquidated without consultation with the portfolio manager. The risk here is obvious. If a position is liquidated unilaterally by a broker, a portfolio manager can sustain losses, especially in the case of a large adverse move on a specific position. Portfolio margining is a type of margining discussed earlier within the spam risk array in which all of the securities within an account is margined and offsetted. In this case, if a portfolio manager has offsetting positions, long one security versus short another security, the manager will not be punished for losses due to only one security going in an adverse direction. In fact, gains on one security will offset losses on another security. For example, if a portfolio manager has a long heating oil position against a short crude oil position, a downward movement in petroleum will create losses in heating oil that might generate a margin call. These losses will be offset by gains in crude oil, which will mitigate the need to post additional collateral. If heating oil was liquidated by the broker, the portfolio manager could then be subject to an upward movement in petroleum, which would create additional losses in crude oil. And that's why portfolio margining is so important to portfolio managers that are going to have long and short positions. Margin positions come with significant risk. As discussed earlier, a $6,000 margin post can give control of a $90,000 position. This can create significant gains as well as significant losses, and it is very important for a portfolio manager to have a robust understanding how margin works within their account prior to transacting with specific brokerages.